Here to help us wrap up the day and the first month of 2011 is Bert Boksen. He is Managing Director and Portfolio Manager at Eagle Asset Management. He is a small cap, or his small cap and mid cap growth funds, I should say, are among the top funds in their classes for 1 year and 5 year returns. So congratulations on that. Thanks for joining us as well. Bert, let me start by asking you about the small cap and mid cap stocks, because a lot of guys are talking about, Barton Biggs included today on surveillance, moving out of those stocks and moving into large cap, the quality names, as they always love to say. What do you think about that strategy here?
Well, you probably get a little short-term valuation correction in small caps. They really didn't participate in the rally in January. They were down, I guess, about 2% in the Russell 2000. And right now, the small cap, the Russell 2000, trades at about 21 times earnings, and the S&P trades at about 14 times forecasted earnings. And while a short-term correction might be in order, longer term, the small cap market looks extremely attractive. The thing that's powered a lot of the growth in small caps, they're up from the March bottoms about 110% as the March 09 bottoms. It's been powered by a lot of takeover. And if you look at the economy, large caps are growing about 3% a year. They have trouble growing a lot more than GDP. And they need to make acquisitions. Their balance sheets are flush with cash. Private equity is flush with cash. And we think that's going to continue. And
let me ask you, Bert, you think that the government is going to help stimulate more than 3% growth this year? And obviously, your bet on small cap and mid caps is really a growth story as well. Do you think we see more stimulus money? Do you think we see spending continuing at the sort of breakneck clip that we saw last year?
Well, QE2 scheduled to end in May. I think it'll be extended, or possibly a QE3. This is the third year in the election cycle, and they will spend. And the government is going to try to spend their way out of the unemployment situation, and they will do what it takes to bring unemployment down ahead of the presidential election in 2012.
Hey, Andrew Keene. Hang on for a second, Bert. I just want to bring Andrew Keene into this, because, Andrew, we've been watching the trade throughout the day. Not too shabby in terms of the moves that we've seen, despite some of the concerns in Egypt and so on. I know we got some good economic news. What do you make out of today's moves?
I've been talking about it on the show that you have to be a buyers of dips. Unfortunately, I didn't buy on Friday, and actually yesterday when we opened up, the SPOOs were down 8 handles. So we were trading even lower, trading around 1267, and I didn't buy any. And we rallied up. We had about a 20 handle reversal. The thing that's scaring me a little bit is the VIX really hasn't come down as hard as I thought. We traded over 20 in the VIX. The VIX was up over 3 points on Friday, and on a Friday, that's a huge move. We're up 10 points in the SPOOs today. You'd think you'd see a reversal back down in the VIX, but we didn't see it, so there might be a little bit more concerns going forward. I don't think Egypt is going to be a concern that's going to push our economy lower and have this reversal of 5 to 7%.
Hey, let me just jump in here real quick, Andrew. The fact that the VIX is up, isn't that just a function of the options market makers saying, hey, we're going to make you pay if you want to buy put protection?
Yeah, I mean, it's the VIX is uncertainty, and the VIX is also calculated by the SPX, the out of the money options. And usually when the VIX is higher, that means we're going to have more movements intraday. And we're having, today we had a 10 handle range. We weren't all over the place. We were down huge on Friday. We had a huge move on Friday, but the VIX being this high, indicates a higher percentage move on a daily basis.
Hey, everybody, I want to bring in somebody into this discussion, somebody that we talked to earlier on Bloomberg, Morgan Stanley strategist Adam Parker. He is the most bearish strategist at the big U.S. brokerages. He talked to us this morning about risks, including the Egypt protests, and really how they factor into his stock market call. And he is concerned. He talks about having a more balanced view, not a bullish one. He says, guys, he thinks that the market multiple will come lower with tail risks, Egypt being one example, many others. It could also be sovereign debt or U.S. debt ceiling. I mean, Bert, safe to say, you have a more bullish outlook here. There are a lot of factors. A big plate out there of things that need to be dealt with, and they're not easy. Isn't that going to, at some point, start to restrain market moves pretty substantially?
Well, there's always macro factors. I mean, the glass can always be half full or half empty. The fact is that equity investors have been stung twice in the last decade, first by the internet bubble breaking and then by the financial crisis, and they're woefully underinvested today. Predicting the next crisis is pretty much impossible. I don't see anything out in the horizon other than the debasing of currencies, and I think with interest rates, the 10-year is still below 4%. I don't see that having any sort of a crushing effect on equity markets. I think we go back to the norm of 10 to 15% returns in equities. You're also going to see a big shift out of fixed income.
Back to the norm of 10 to 15% returns, what, annually for the future as far as we can see, or what do you mean?
Well, I think 10 to 15% is a normalized return historically, and I see no reason not to expect that this year. I see a shift out of fixed income, which has been on a 15-year bull market. And if you had to suggest where the bubble might be, it might be in fixed income as opposed to equities.
Hey, Andrew, you buying any of this?
I mean, yeah, I believe some of it. I look a lot more short term, so I'm just looking at price action. And, the price action is we're going higher. Anybody can come on and say, the reason the market's going to go down is because oil's too high or gold's too high or, corn's too high or all the commodities are so high that's bad for the consumer. But the fact of the matter is that we're in a bull market. We keep going up. Anytime we get pushed down, there's buyers and people are buying the market. Historically, January is a really weak month, and we're pretty strong in January.
I got to ask, Andrew, if you buy 10 to 15% annual returns as the norm over the long run, why bother with short-term trading?
Well, I trade short term because we move so much. If you look at it, we had a 25 handle SPOO move on Friday. That's a huge percent. And then today we were down 8 last night. We were up 12 today. There's a lot of moves intraday and overnight in the Globex session. That's a couple percent here and there.
Dom, you're feeling me on this, right? Because that's pretty sweet.
10 to 15% as a normalized return would be something where I would just fire and forget. Forget about what happens in twice in 10 years you get snake bit. But if you're making 10 or 15% a year on average, that's kind of huge. But right now, if you look at what's happening, guys, we look at what's happening with growth stocks versus value stocks, and that's where you're kind of seeing a pivot point. Perhaps you talk to strategists out there, and what they've said is over the past year or so, you've seen growth stocks really outperform, and that's what happens in the initial stages of a recovery. But now things are getting better. People are going back to work, supposedly, all right? Valuations are getting a little bit better. Earnings are coming in good. So now's the time people are saying, hey, fundamentals matter. Look for value stocks, and that could be the next thing that propels the stock market higher. So maybe, Bert, what I'm asking you is, do you see that turn happening? Are people going back to value stocks as opposed to growth stocks now, Bert?
Well, we don't see it, and sometimes it's definition of what's a growth and a value stock. We see big, some of the cyclical stocks should do extremely well. We're in the very positive early stages of an auto cycle as auto sales are picking up. The trucking cycle looks awfully good. So we see a lot of positives in coming out of cyclical stocks, and tech looks very strong. One of the reasons we had the rally today, despite Egypt, is earnings are so strong. Over 70% of the companies that have reported thus far have beat their estimates, and not just on the bottom line. There's some very nice top-line gains. So I think the economy is, in fact, improving. Comparisons in the first half are easy, and I think this rally that we're seeing today may continue.
All right, hey, Bert, I want to thank you. Bert Boksen there, Managing Director at Eagle Asset Management. Andrew Keene, I want to thank you as well. Pleasure, as always.